The exchange rate of Singapore against yuan is 5.15. Yuan is depreciating against SGD. This might be due to the recent tariffs imposed by both the US and China. China is known to offer low prices for manufacturing goods and services as compared to other countries as shown in the Big Mac index above. This creates a growing demand for China goods and services.
In 2016, China's interest rate has been on a constant as shown in the above figure. It has the highest interest rate amongst its top 3 trading partners. China's central bank will stick to lower its interest rates and boost bank liquidity to encourage more lending and support the economy despite the skyrocketing pork prices across the country. On 5th September, it has also announced the third cut of the bank's required reserve ratio. This is the amount of money banks must hold in reserve at the central bank. This hence frees up 126 billion worth of funds that banks can lend. China's trading activities has been increasing throughout the last 10 years, showing that China is now more open to trading with other nations. China is the biggest holder of US government debt. If problems start arising with the US, China will definitely be the first to feel the impact. China faces a slowdown in domestic demand with the removal of government subsidies. In 2018, the fixed asset investment, which is an important factor of Chinese growth, grew at a very slow rate. Retail sales is also increasing but at the slowest pace since 2007. As shown above, the continual drop in consumer demand will definitely affect China's economy. The figure above shows that the CPI has increased as compared to the previous period, resulting in an increase in the inflation rate as shown in the next figure. The two main causes to the rise in inflation rates are the outbreak of the African swine fever, contributing to the rise in pork prices, and the severe weather in China, which contributes to the rise in fresh fruit prices. This thus leads to the increase in food prices, which jumped to 9.1% in July. Inflation will rise and trade war between China and the US is expected to continue. The tariff imposed will definitely affect China's exports, especially in the manufacturing sector. China's growth rate is expected to drop from 50 to 100 points, but will still remain relatively high. This also means that overall output is expected to fall, hence affecting its GDP. China will still perform way better at 6.2% than the world average growth rate of 3.3%.